Thank you. Thank you. Um, Before we dive into the next bit, first of all, thank you, Thomas. That was a very excellent presentation, and I'm going to try my best to try to match that. But before that, if I could, I think we are good on the visual, and then I just want to confirm that you guys can also hear me. So I know you guys can see me, but can you guys hear me once I have microphone check? We can go ahead and dive in. All right, I'm seeing that you guys can hear me. So with that in mind, we are ready to dive in. So the topic here, trading when diversification fails, practical strategies and tips. Now, before we dive into the good stuff, we're going to start off with the usual disclaimers. So let's go ahead and begin. So just to reiterate here, as Thomas did, the views, opinions, or recommendations of me are solely of my own opinion, and they do not reflect the views, opinions, endorsements, or recommendations of IG Asia. And this information should be largely treated for educational purposes. I see a comment here that might sound a bit low, so I'm going to try to move my microphone just a little bit closer. So if the sound is a little bit better, keep me posted. Moving on here with disclaimers, please remember that CFDs are complex trading instruments. They come with high risk of losing money rapidly due to leverage. Leverage is like a double-edged sword, right? It can both amplify your gains, but also do the same to your losses. Okay, so just reiterate and brief introduction about myself. So as mentioned, I've actually been with DailyFX since 2014, and I started as an intern actually for the Asia Pacific desk. And yes, I've been cited by news agencies such as The Telegraph, Yahoo Finance, and NASDAQ.com. Lately, I've also been doing a lot of work for Reuters. And if you would like to listen to some of my views on markets, I do weekly appearances for Tasty Trade, talking about markets in a more laid back, relaxed, and really open discussion, kind of podcast-like setting. So if you guys haven't followed me on Twitter, it's at @DDabrowski, capital F, capital X, and you can actually see some of the recordings of those there. All right, so let's begin to the actual bulk of the presentation. So as you've seen, diversify to reduce risk, they say. This too can fail. The most balanced portfolio can succumb to systemic market risk. So in this session, we're going to discuss practical strategies that traders can use to defend against such threats and even look to prosper amid market stress. So this session is divided into 3 sections. We're going to begin with the significance of diversifying trading portfolios. Then we're going to move on to using what's called the VIX fear gauge to identify conditions where portfolio diversification can fail. And then we're going to wrap it up with talking about how you can position yourself for market volatility using specific trading strategies. So beginning with part 1, the significance of diversifying trading portfolios. So this is not a session that is going to be all about what is portfolio diversification and how you can use portfolio diversification. Rather, we're going to start off with just a brief general overview of what portfolio diversification is, because later on, I'm going to be showing you guys sometimes when portfolio diversification can fail and what we can do about it. But in order to talk about being able to succumb to the downsides of portfolio diversification, you have to understand what it is. So we're going to do a brief overview of what that is. So the general idea here is that at the core level, portfolio diversification is the broadening of range, a broadening of a range of products. It is the exact opposite of putting all of your eggs in one basket, and you can broadly expose yourself to various corners of the market, whether it's currencies, commodities, as Thomas was just talking about, equities and cryptocurrencies. But also within each of those corners of markets, such as, for example, stocks, you can also diversify yourself within those components. So diversifying yourself in stocks is like trying to pick different various sectors, like information technology, healthcare, energy stocks, and whatnot, right? And the importance of all this is that diversifying yourself and your stock portfolio and also other elements of markets can help you get through volatile periods. Because sometimes, but not always, losses in a sector of the market could be offset by gains in another. So for example, we know that stocks this year have not been doing particularly well, minus the past couple of weeks. But there has been a corner actually in the stock market that has been performing well, and that is energy companies. So if you had diversified yourself and perhaps found that perhaps energy stocks could do well, perhaps some gains there could have offset losses in other corners. But the key point here is that diversification can help you navigate around what's called systemic and unsystemic risk. Now, what is systemic? Systemic is very broad-based. So for example, the US dot-com bust, the 2008 housing crisis, and even the COVID crash to a certain extent, those were all systemic-based crashes. They impacted many corners of markets. And unsystemic risk is a little bit of the opposite. It's very, very sector-specific. If you recall, yes, cryptocurrencies, Bitcoin especially, have been down a lot this year, such as 50%. But prior to COVID, there was another crypto crash, I believe in 2014 or 2016. But that was very specific to the crypto space and whatnot. And so that is unsystemic risk. Another unsystemic risk could be, for example, if you just look at very specifically certain travel stocks, right, as COVID started. But when it comes to diversifying your portfolio, specifically within the stock market, and the reason why I'm looking at the stock market is because in order to be able to protect yourself through volatility, a person need to be able to identify what that volatility is. And oftentimes we use stocks to find those volatile periods. And when it comes to the stock market, there are many sectors that you could choose from. Now, this specifically is the S&P 500, and you'll understand here in just a couple of slides why I'm picking here the S&P. But within the S&P, there are 11 sectors. They range from information technology, healthcare, consumer discretionary, communication services, and so on and so forth, right? So a balanced and diversified portfolio could, for example, be one that has some exposure in some various corners of these sectors. Now, if you diversify yourself, right, then perhaps losses in one side of the sector could be offset by gains in another. But as we're going to find out, that's not always the case. Now, these are just, we were looking at those specific sectors of the market, of the S&P rather, such as information technology, consumer discretionary and whatnot. And each of those sectors, right, can be actually traded through indices or ETFs. And this is just how some of these have been trading since the stock market bottomed in 2020. So you can see how let's say if you were going on a diversified portfolio and you had some exposure in energy stocks, well, some of the gains in energy stocks, as you can see here, could have offset some of the weaknesses seen in, for example, information technology, industrials, financials, and healthcare. Even though that prior to 2022 and after markets crashed in 2020, the energy sector was largely underperforming. So even when a certain sector is perhaps consistently underperforming, there could be a time perhaps when it's ripe to shine. And that really has been throughout most of this year so far. So the three key takeaways about portfolio diversification, right, is that one, it helps broaden your exposure to markets, and it helps you to place all of your eggs into one basket. And should that basket be accidentally dropped, it could help defensify your portfolio against those kinds of situations. And it helps you to navigate around systemic and unsystemic market risk. And when it comes to the stock market, you have plenty of sectors to choose from. Now, portfolio diversification is all fine and dandy. And I just want to make it absolutely clear here that this is not a webinar to undermine the significance of portfolio diversification. Rather, it's quite the opposite. Portfolio diversification is very important, but it's not impervious. Nothing really is perfectly when it comes to trading the stock market. And as we're about to find out, I'm going to show you guys when portfolio diversification actually can fail using what's called the VIX fear gauge, right? So what is the VIX gauge? I'm not going to spend too much time talking about what it is fully in depth. I'm just giving you guys a brief overview of what the VIX is, because as we're about to find out, we're going to be using the VIX to actually find conditions when portfolio diversification can fail. And once we know those conditions, I can then walk you through how to navigate them. But the VIX, also known as the CBOE, or the Chicago Board of Exchange Volatility Index, is known as the market's preferred fear gauge. It was created in 1990 to use as a benchmark for analyzing volatility projections in the US stock market. And generally speaking, right, if we know where volatility is going in the US stock market, that is generally a precursor or alluding to perhaps what's going on not just in the US, but all over the world. 2008, for example, was a great example of that. And to a certain extent, what we're currently seeing actually in markets following the US economy contracting for second quarter, meeting the technical definition of a recession, right? Now, the VIX trades in real time, kind of like stocks and currencies, and it reflects expectations of price movements over the next 30 days. So, as a result, the VIX naturally has a very close inverse relationship, right, with the S&P 500, which is what you're currently seeing in the chart presented in front of you. Now, this particular chart goes back to just before the global pandemic started. And so you can see how when COVID started to impact the broader world, how the S&P 500 dipped here, this red line, and the VIX shot higher, reflecting elevated volatile conditions. And then the S&P 500 started to recover. S&P 500 climbed and climbed and climbed up until the beginning of this year. Meanwhile, the VIX was actually doing the opposite. It was falling up until just before the S&P 500 actually topped. And ever since the S&P 500 has been falling, the VIX has been slowly rising. Because again, we're talking about those expectations of volatility, and the way it works is as stocks fall, they tend to fall quickly. They fall a lot more quickly than they rise over time. And these moments tend to be sometimes short, sometimes a little bit medium term, but they're quite rapid and swift. And so that is why volatility rises when stocks start falling, because it tends to happen very swiftly and quickly as panic starts to impact investors. And of course, the opposite of that is true when we're in good times and things are slowly rising. Now, lately, I've had a lot of interest in data analysis and using that knowledge to try to help you guys. And so if you've actually been following me, you might be familiar that I wrote an evergreen piece a couple months ago where I break down basically how to use specific price levels of the VIX to identify volatile market conditions. And I'm about to present to you guys those findings. So there's a lot of information here that I'm about to present, so just a heads up. And I encourage you guys to not get too entangled with the data, because I have an article that you can read on your own time that talks about this entire second section. But to get to the point here, I'm about to show you how I was able to use data from the VIX and the S&P 500 and sectors within the S&P to help you identify when it's time to be alert and when you should consider a trading strategy to help you with volatility, and when those volatile conditions can erode the usefulness of a diversified trading portfolio. So let's dive in. This is the first chart, and this one is pretty straightforward. So there's a lot of things going on here, but here's the key takeaway. This is data, weekly data for the VIX going back to 2002. And the reason I use weekly data instead of monthly is because a lot of things can happen on a week-to-week, even day-to-day basis that a month-to-month trend may not capture. What do I mean by that? Let's say the VIX was at this price in January, and then it was at this price in February, and then it was at this price in March. Well, yes, you can measure the VIX every month for that and calculate the average VIX levels for each month going back to 2002, but you're going to be missing, I think, some of those week-to-week levels. So what I did here, right, is this orange line is the average price of the VIX for a given month going back to 2002 using weekly readings. So for example, in January, the average VIX price was 19.25 based on weekly changes. And then it rose to 21.03 here in March. And then it fell to a low of 17.8 in July, and then rose back up to 21.23 in October. Meanwhile, these blue horizontal lines is the average performance of the S&P, again, using those weekly values. And you can kind of see an inverse relationship. So if we take a look over here, right, there was a peak average of 21 for the VIX for March. So March tended to be a historically volatile month for the US stock market. And guess what? The average return of the S&P was negative 0.24%. That makes sense, right? The VIX and the S&P are inversely related. So at high levels of VIX, we would expect worse performance in the US stock market. Now, from March until July, we saw the VIX come in at weaker values, and the S&P 500 started to perform better. And you could see how starting in April, there was an 1830 VIX rising to 21.23. Meanwhile, the S&P 500 performance gradually deteriorated. So as volatility climbed over the months, performance in stocks declined. And that makes sense because the way the VIX is structured. So now this is where things are going to get really interesting. And again, I wouldn't get too tangled up with the data. I have a dedicated article that you can find on my author page that talks about everything in the second section. So the question is, how do I identify conditions where portfolio diversification can fail? Well, what I did was I took an index of each S&P sector. So that's going to be 11 sectors, right? Each of those has a price and a performance going back to 2002. It could go further than that, but for the purposes of the study, it goes back to 2002. Now, each sector, such as information technology, healthcare, financials, etc., has a correlation reading with the VIX. Now, what correlation is how related two things are over time. So, for example, a negative correlation means that as one variable rises, the other falls. A positive correlation is as one variable rises, the second one also rises. Now, I should stress here that correlation does not imply causation. For example, on hot summer days, what do we tend to see, right? A rise in ice cream sales, right? And let's say a rise in sunscreen sales. Now, does rising ice cream sales impact rising sunscreen sales? Probably not. It's the weather. On hotter days, people tend to buy more ice cream or more cold drinks and perhaps more sunscreen to protect their skin. It's not that sunscreen and ice cream are related to each other, it's the weather. That's sort of, what we mean when we say correlation does not imply causation. Anyways, you can take the correlation between each S&P sector and the VIX, which would be 11 readings for a given day, and you can average them. Then you can separate those into three groupings that I laid out here: strong negative, medium negative, and weak negative. What do I mean by strong negative? For example, in May, this bar here, right? What does this mean? So in May, on average, when correlations between the sectors in the VIX were stronger than negative 0.75, the average price of the VIX was 36. And when correlations were a lot weaker, meaning each sector was moving more freely next to each other, the average price of the VIX was 17. And what we see here is that for basically 7 out of 12 months, so a little over 50%, higher levels of VIX were associated with stronger inverse correlations between the sectors. And so what does that mean, and what can we do with this information? You can construct this. So what is going on here? So on average, for example, here, when sectors, each S&P sector was moving more freely next to each other, there wasn't a whole lot of volatility, and you could perhaps spend more time trying to pick which sector was the best. The average reading of the VIX was about 16.7 or almost 17. Meanwhile, the average return of all the sectors was 1%. When conversely, we saw more inverse correlations between all the sectors in the VIX, average price of the VIX was almost 23. And guess what? The average return between all the sectors was almost negative 0.5%, or basically what this shows you, right, is that inverse correlation performance. So as correlations between sectors in the S&P become more strongly inverted with the VIX, meaning that as the VIX goes up or VIX comes down, all the sectors tend to do the opposite of what the VIX is doing. And you get very dismal returns from the stock market. And conversely, when volatility is low, the sectors tend to move more freely relative to each other compared to the VIX. And on average, they return 1% at this price. And over here, somewhere in the middle. So again, if you want to read, I know this was a lot of information, but if you want to read more about this study and what these charts mean, I do have an article about it, and you could follow me on Twitter, ddbrofsky, capital F, capital X. I have it tweeted there, and you can visit my profile page there. But anyways, knowing that data, we can now apply it to the real world. So 16.72 was the low VIX threshold. So when VIX is at 16.72 and below, going back to 2002, this is when we tend to see the most free movement between all the sectors. And you can see that here. Now, this is from 2017 to almost the end of 2018. And we can see here that the VIX was trading below 16.72. Volatility was low. The S&P 500 was slowly rising. But look what the sectors were doing. Information technology was gradually rising over time. And so was healthcare, actually. Healthcare was also rising over time. But healthcare was a little bit more volatile. Like, it went up, it went down a little bit, it went up and then down a little bit again. Meanwhile, energy stocks, they gradually fell over time before rising just a little bit. And what this is really demonstrating, right, is that over here, when the VIX was below this price of 16.72, the sectors were moving more freely. And there was room here for you to be able to, okay, pick which sector might do better or worse. Let's say you had a bad feeling about the healthcare and you were able to predict, let's say, this decline, or you had a bad feeling about energy stocks, but a good feeling about information technology. If you had sold energy and bought information technology, you would have been done pretty well. Volatility was low and the sectors were kind of doing their own thing. And you could develop a pretty decently going diversified trading strategy. Now, what happens when volatility rises? So if we recall, right, the high VIX threshold from the data was 22.85, or almost 23. And you can see this is going back to COVID. Volatility here spiked as the S&P 500 declined. And then the S&P 500 started to recover. But there was this little period here where it dipped, volatility spiked again, and then continued to rise, and then VIX came down. So, but during this entire period, the VIX still remained above this 23 number. And you can see how all the sectors that we just looked at in the previous slide were moving together. When volatility goes up and we get above this threshold, a diversified portfolio strategy loses its significance. Because let's say you were, I don't know, you were long energy stocks, but you were short information technology. You would have lost money in your energy technology, but okay, you would have perhaps gained some in the other. But point is, all of these are now moving in the same direction. And when everything is moving in the same direction, it's hard to be diversified. And after stocks stopped crashing in 2020, yes, they started to rise, but they were kind of still moving very closely together. And then when we had some more volatility again here, again, we never were able to drop below this threshold. They all start moving in the same direction. So this is what I mean, empirically speaking, not just, hypothetically speaking, where portfolio diversification fails. When volatility goes up, it becomes very hard to diversify because sometimes things just start moving systemically in the same direction. And that actually is going to bring us to the conclusion of the second section. And so 3 key takeaways here in terms of identifying market conditions when diversification can fail. The first is we can use the VIX, market fear gauge, to find conditions where portfolio diversification can fail. At VIX levels of 17 and below, conditions for diversification are more ideal because volatility is low and all the sectors in the stock market are more or less kind of doing their own thing. And it allows you to try to pick and choose, what might be better, what might be worse. But as soon as volatility comes, and at VIX levels above 23, a diversification strategy loses some of its appeal. Again, and I want to make it absolutely clear that I am not speaking here to undermine or downplay the importance of portfolio diversification. I think it is very important. And every trader, to a certain extent, should be using portfolio diversification to help hedge against this kind of systemic market risk. But I just want to show you guys that it isn't always perfect. But more importantly, I want to show you guys how you can identify conditions where portfolio diversification fails. And if you know when diversification fails, you can adjust your trading strategy. Which brings us to the last section, positioning yourself for market volatility with specific trading strategies. So here are some general trading strategies for high volatility. The first is you need to be aware of high volatility. And that was what the entire section before this one was about. I showed you guys how you can use the VIX and at what price to identify likely conditions when portfolio diversification can become not quite as effective, and conversely when it is a little bit more effective. So if you know to expect this volatility, you can adjust your trading strategy, which is number 2. Consider diversifying to a near-term trading strategy. Now, I'm sure for some of you, you guys have perhaps 2 layers or 2 components of a trading strategy. The first is you have your retirement strategy, or your investment. You're investing for the long run in various corners of the markets to help you in retirement. Now, when you know to expect high volatility, it becomes difficult to pick what sectors to choose because everything starts moving in the same direction. That direction is down. And so what you could do, for example, is diversify to a short-term trading strategy and play the volatility, which is what I'm here to talk about. You could use, for example, a medium to long-term investment strategy for retirement and shift perhaps to a short-term strategy when volatility is high to play these volatile periods. Now, another component for high volatility is adjusting your risk and maintaining consistency. And I'll show you guys what I mean by that here in the next slide in just a second here. The fourth one is to factor volatility for stops. If you know volatility is high, then you know you could probably expect more sudden, erratic price action. And if you know to expect more sudden and erratic price action, well, you could adjust the distance for both your stops and targets. Finally, you should know how certain assets behave and how they are impacted by volatility. For example, we'll talk about the US dollar, we'll talk about the Japanese yen, we'll talk about even gold and also sentiment-linked currencies. But let's move on here. So this here, I want to show you guys the significance and the importance of maintaining consistent risk. And this isn't necessarily something that you should only use during volatile market conditions. This is something that I think everyone should be using regardless if we're seeing market pandemonium out there and the whole world is shutting down because of COVID, or we're moving past that and conditions are quiet. It is, in my opinion, that the key to success as a trader as a whole is to maintain optimal risk management and being consistent. And this is what this slide helps you visualize. Now, I simulated this, what's called a random person trading 100 times in Python. So I coded this. So this person here started with a starting balance of 2,000. It could be dollars, could be yuan, could be whatever. And this person was risking 1% per trade. What do I mean by 1% per trade? So, well, their starting account balance is 2,000. That means every trade they are basically risking $20. Now, obviously, as you make and lose money, this risk will stay consistent, but your value will change. So, for example, let's say in the first trade you made some money, you made $20. Your new account is now 20. So you have $2,020. Well, now on your next trade, you should risk 1% of that. So that's no longer going to be $20. It's going to be something like $20 and like 10 cents or something. Now, this person, I coded it so that they're lucky only 25% of the time, which means that every time here they place a trade, there's a 25% chance that they will be profitable. Conversely, a 75% chance that they will lose money. So this trader is quote unquote unlucky. Using an optimal, what's called risk reward ratio of 5.3 in this study helped him to still be profitable after 100 trades. Now, again, I want to stress here that this is a simulation and is not reflective of the real world. This simulation assumes this person trades 100 times over the course of their life and no less and no more. And it assumes they can perfectly exit their trades at the stops they need to and at the targets they want. But as we know, in the real world, that's not always the case. Really, the point of this simulation is to demonstrate that even someone who's lucky a pitiful 25% of the time can still make money. This person walked with an $844 return despite being lucky only 25% of the time. And you can see why. They lost money a lot, but they only lost 1% of their account per trade. But they were shooting to make 5 times as much as they risk per trade. And so, for example, you can see loss, 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 and then they won once, twice, and 3 times. But each time they won, they shot for a high risk-reward ratio to counteract their unluck. And so again, the key takeaway here is that whether or not we're dealing with volatile conditions or things are relatively quiet, in my opinion, you should be very consistent with your trading strategy. Be consistent with your risk, be consistent with your risk-reward ratio. And that is the key, and in my opinion, success to be able to hedge against your luck, whether you're lucky 50% of the time, whether you're lucky 40% of the time, 30% of the time, or in this case, 25% of the time. Even someone who's lucky 10% of the time can still make money. They just would have a really, really high risk-reward ratio. And that's the significance of maintaining consistent risk. Now, another method we can use when diversification fails and we're experiencing high volatility is using that volatility to influence and impact our stops, which is what this chart demonstrates. Now, this could be really any instrument. In this case, this is Aussie dollar, Aussie USD. But down here below is what's called average true range. That is the shaded blue area. And all average true ranges, it's just the difference between the highs and lows of the next candle, or for the current candle rather, to show you how many, in this case, pips a given asset moved up or down. Now, I applied a moving average to this, a 10-day moving average. And what this does, right, is lets you see on average over the past 10 days, the range of Aussie USD tended to be, well, in this case, 79 pips. And you can see how this evolves over time with the price action. So for example, you can see this period from April to the middle of May was quite volatile. Aussie was falling a lot and making very sudden, erratic, and swift moves. And the average true range, the moving average, started to climb. And when it climbed, it was reflecting that we saw more active price action. We saw more larger ranges, more heavy movement, right? And then over here, when Aussie was rising, you could see the volatility start to fall. And we saw the range on the 10-day moving average decline. So knowing the volatility of a given instrument with the average true range can help you decide if your stops are perhaps too narrow. So for example, let's say, in this case, right, Aussie dollar up or down. In this case, let's say you're looking down. You think Aussie dollar is going to fall. Well, the average true range, 10-day average, is 79, almost 80 pips. So for example, let's say you had a stop that was in line with this June swing low. Now, is this stop too narrow, too close to where prices is? Well, it probably is, because it's below 79, right? There's a high chance, perhaps, that in the next day or two, or in the near term, we'll see this perhaps come up to your stop. Conversely, right, this next potential stop is 191 pips away, which is not quite 3 times, but we'll say almost 3 times the distance of ATR. And so you can use average true range in this regard to identify if your stops are too close to where you get in. All right, we're coming to the last 10 minutes or so of this presentation, and I'm going to wrap things up with showing you guys specific assets that are impacted by volatility, how you could trade them when you know volatility is ripe. But I also want to encourage you guys to ask any questions you may have or clarifications about what I'm talking about. Please put that in the chat box below. I actually already see a question here, and I will address that question once I'm done here. But anyway, so what you see here is basically a gauge of the US dollar. This green line here is a majors-based dollar index that averages the dollar against some of its major peers. And down below here is the S&P, and this is since the beginning of this year. So you can see as the S&P 500 was falling, the dollar was rising. Now the dollar tends to play a haven role in markets. When things are starting to look ugly, what do traders do? They get out of their trades. If you bought Netflix, if you bought Apple, and you see that stocks are tanking, you could get scared and you could exit your position and avoid taking further losses. But what happens when you get out of your stock? You exchange your stock for cash. Whether you made or lost money, you're converting your stock to cash, and the cash of choice often tends to be the dollar. The US government has also never and will likely never default on its debt obligations. That also makes it an ideal place to hedge when volatility is ripe. So if we can expect high volatility, the dollar could perhaps be poised to benefit. Now, there's another currency that tends to play a haven role, and that is the Japanese yen. But as we're about to show, that's not always the case. This blue line is a majors-based yen index. This is back when markets crashed in 2020, and we can see that the yen appreciated when markets crashed. You can see here the S&P 500 is taking, yen is rising. But also do note that government bond yields were falling, and we'll get to this moment here in just a second. So the yen also tends to sometimes play a haven role. One reason is that inflation, generally speaking, has historically been very low in Japan and still is to this day, despite inflation all over the world. Although inflation is creeping higher in Japan. And so because the yen doesn't really get deflated by value as much, some people like to park their currency in the yen because they can perhaps expect it to not lose value over time. But it's not always true that the yen behaves as a haven. This year, perhaps some of you guys were caught off guard. Perhaps some of you generally knew that the yen tends to rise when stocks fall. Well, if you've been trading the yen and you've been trading with that mindset, you probably have been disappointed this year. You can see here the S&P 500 was falling this year, but the yen was also falling. But why was the yen falling? Because government bond yields were rising everywhere. The Bank of Japan still is the most dovish major central bank. Even the Swiss National Bank has started hiking rates, except for the BOJ. So as a result, returns on cash and on bonds in those countries all increased, except in Japan. And at the end of the day, the return you get on cash is very important. And so you can see that is what likely contributed to the yen weakening, even though we saw stocks tanking. The Australian and New Zealand dollars, those tend to be very closely linked to the global business cycle. And as such, they are very vulnerable to global growth expectations. And where do we know global growth expectations have been going? They've been going down because of monetary tightening. And so we've seen the Aussie, the Kiwi depreciate alongside the S&P 500. So if you know that volatility is coming, and you know that conditions are ripe for volatility, and portfolio diversification isn't working particularly too well, perhaps there's some plays to be made against the Aussie and the Kiwi dollar. Now, one very unique, in my opinion, currency pair is Aussie Kiwi. Now, we just talked about how Aussie and the Kiwi tend to be sensitive to sentiment. But let's say the Australian dollar falls because stocks fell, and the New Zealand dollar fell because stocks also fell. Well, if both the Aussie and the Kiwi are falling against the markets, then against each other, well, if the Aussie is down and the Kiwi is down, technically against each other, they haven't really done anything. It's all about relativity, right? And anyways, what I'm trying to get to here is that when volatility is ripe, Aussie Kiwi can be a fun currency pair to trade because it helps to net out swings in sentiment and rather becomes a more function of what's going on between Australia and New Zealand. And Aussie Kiwi has been rising a lot lately because, well, the RBA has become increasingly more hawkish than New Zealand. I would also argue that Russia's attack in Ukraine has been boosting demand for Australian goods more so than New Zealand, because Australia produces a lot of the goods that Russia does, except for oil. But Europe needs an alternative to Russian materials, and Australia is a natural choice. And so I think that's one reason why this pair has been rising. And finally, the last pair we'll talk about here, last instrument, is gold. People often ask me, is gold a haven? And as we've learned this year, it is not. You can see here how gold has been falling, even though the S&P 500 has been doing the same. Gold, at the end of the day, is an anti-fiat instrument. It's heavily influenced by what the dollar is doing and what treasury yields are doing. We know that the Fed is incredibly hawkish. And we know that they are trying to raise interest rates to tame inflation. And as a result, bond yields have been rising. And the dollar has been rising. And gold has consequentially been tanking. So if you have to ask the question, why are we seeing volatility? Is it because the Fed is raising rates? Well, then you know what gold is probably going to be doing. It is also the same reason why this past week has been very good for gold, because people are expecting the Fed to stop raising rates and reverse course, aka yields come down, dollar reverses, gold rallies. And so, conclusion and key takeaways. Strategies for when diversification can fail. When volatility strikes, consider diversifying to near-term trading methods, right? You have your retirement and your investment strategy, and perhaps you have your short-term strategy. Volatile periods tend to be short-lived, whether it's months or a year or two versus the long run. And so if you know conditions for volatility are ripe, then you could perhaps change your mindset. The dollar and sometimes the yen tend to play out as anti-risk instruments or vehicles. If we know volatility is ripe, and if we know conditions are not ideal, the dollar and the yen can benefit quite handsomely. But with the Japanese yen, it's not always the case, as we saw this year. Sentiment-linked currencies like the Aussie and the Kiwi tend to be more vulnerable. So if we expect, as Thomas was talking about in the previous session, if China here continues to slow, well, that's not good for Australia. And that's not good for global sentiment. And finally, gold's appeal as a haven is not always a safe bet. Rather, gold tends to focus more on what's going on with monetary policy in the US and the US dollar. And that brings us to the end of the session, where I am now going to address your questions. I have a few minutes here. So if you guys have any questions, we'll address them at a first come, first serve basis. I already see a couple here, so do get those in there. I probably won't have time to go through all of them, so just FYI. Question, is the VIX above 20 correlation with the Dow and Nasdaq better or worse than the S&P? So the VIX, and let me just go back here. I'm gonna go back here just a little bit to when we were looking at the VIX. So the VIX is derived from options trading in the S&P 500. So it is going to be the most important to compare the VIX to the S&P, not the Dow or the Nasdaq. Having said that, the Dow and Nasdaq obviously tend to be very closely related to the S&P, because again, you're just looking at the US stock market and different corners of it. So I would focus looking at correlations between the VIX and the S&P, and then perhaps seeing what that can mean for the Dow or the Nasdaq. Next question has to do with moving averages. Let me pull up that slide. Here we go. I noticed that you were using the 10-day moving average for a daily chart on Aussie USD. If you're trading on a 1-hour chart, would you still use a 10-day MA, not EMA, on the average range, or a lower than 10-day MA? Okay, that is actually a very good question. So again, this also depends on your time horizon. Now, I personally am more of a position trader, and I tend to place trades and hang on to them for a while. So I mostly use daily charts and occasional 4-hour charts to help better position trades. Now, if you're trading on a 1-hour basis, right? Understand that, price action tends to move a little bit more quickly, and understand what the 10 number is. In your case, on the hourly setting, right, a 10 moving average on the hourly setting reflects 10 candles. And what do those 10 candles reflect? 10 hours of price action, right? So I would look at your trading horizon, right? How long do you want to hold this position? Is it for 10 hours, more or less? If, let's say, your trading horizon is within 24 hours and you only want to place a trade and hold it for just a couple of hours or whatnot, then yes, a 10 period moving average for an hourly chart could work. But if you want to place a trade using the hourly setting and then hold on to it for a long time, such as like a day or a week or even a month, using an hourly chart with an hourly moving average to calculate ATR would not, in my opinion, be a great idea, because you're leaving yourself vulnerable to your stops getting hit. Because again, what is the 10 setting on an hourly chart? It's for 10 hours. Each candle is 1 hour. So you want to scale your ATR to the chart setting in your time horizon. All right, I'm not seeing any more questions. So I'll give you guys another minute here to ask any more questions you have. In the meantime, I'm just going to pull up here the disclaimer one more time as we are at the conclusion of this session. So a couple things I just want to stress here. Again, I know that middle section was a bit intense of the data. And if you're still a little bit confused as to, how is it that I found that, okay, at VIX level 23, portfolio diversification doesn't matter as much. And at VIX level 17 and below, it's a lot more important. Again, I have a full written evergreen piece dedicated to explaining that second section that you can read by visiting dailyfx.com. And if you go to the author section and find me, you'll be able to find that article. It's titled something like, when can S&P volatility break a diversification strategy? And that is another good time to remind you guys that I do have a Twitter handle at @DDabrowski, capital F, capital X. So if you guys want to stay updated and following what I am watching in the market, what I'm writing about, and my thoughts, and again, those live appearances on media and Tasty, you can go ahead and do it